Welcome to our Taking Stock video for the week ending the 21st of June 2024. I'm Kien Trinh, Head of Research at Stock Doctor, and today I'm joined by our Equities Analyst, Daniel Ortisi, to stream to you all things share market. How are you, Dan?
Yeah, very good, Kien, and excited for another week of taking stock.
Yeah, me too. But before we get started, just a quick yet important reminder, the information we provide today is of a generic nature and therefore shouldn't be taken as personal advice. Remember, shares are volatile, so any charts or tables presented shouldn't be relied upon as a guide for future performance. Well, Dan, the Australian market, it continues to move in a sideways channel with really no clear direction, despite the record highs achieved across the US market. And the reason for this is if you look at the market's dynamics here in Australia, you'll notice that it's been driven by the cyclical sectors such as resources and financials, which are more sensitive to the economic cycle than the US market, which is more driven by tech and healthcare stocks. And with the artificial intelligence boom underway, you can expect the US to be moving forward.
That's right, Kien. And despite the optimism displayed across the share market, it is important for investors to continue to focus on the fundamentals of a business. Invest in companies that have the financial strength to withstand the challenging economic environment. And of course, just this week, if we talk about the economic environment, the RBA kept its cash rate on hold at 4.35% and continued to warn that big spending government budget could keep inflation above the RBA's target band of 2 to 3%. Now, this did lead investors to scale back their near-term prospects of a rate cut down from 47% chance of just 37% by the end of this year.
Yeah, the environment's certainly challenging, Dan, and the higher for longer interest rate environment continues to have a significant impact on the consumer-driven businesses. Just this week, we saw City Chic, a specialty fashion retailer. They had to seek an emergency 27.5 million equity injection, raising equity at a steep discount while also having to sell their North American brand called Avenue to help pay down their debt. But the significant share price decline over the past few years, that hasn't really come as a surprise for our investors who understand the risks of investing in such businesses, with City Chic being in a financially weak position since 2022. And this week's news flow has been quite eventful as well, Dan. X-Star Income stock, Helia Group, they saw their share price close about 20% lower on Wednesday after an update regarding their lender's mortgage insurance contract review with Commonwealth Bank, which is set to expire in December 2025.
Yeah, that's right, Ken. Clearly, the market didn't like the update, given the significant drop in the share price. However, the very next trading day saw a sharp rebound after investors did have a chance to digest the news a little bit more.
Yes, so much volatility there. And it's worth noting that the CBA contract accounts for roughly about 50% of Helia's lenders' mortgage insurance policies, highlighting a significant customer concentration risk. But this isn't Helia's first encounter with this scenario. They faced a similar situation in June 2021 with the market reacting poorly then as well, dropping about 18% on the 29th of June 2021.
Yeah, very well said, Ken. And always good to look back in history and how these events play out. But of course, the CBA contract was not actually the main reason we removed Helia from our star stock at Universe. The real issue at the moment, as Ryan has explained in his commentary, is that the business remains in what we consider a runoff mode due to the lack of high LVR or loan to value ratio loans, of course, being in the market at the moment, as lenders' risk appetite remains low despite a very strong housing market, Ken.
Yeah, and this is why its return on equity is expected to decline quite materially over the next 2 years. Hence, it's not a growth stock from an income perspective as well. Investors may be drawn towards that high gross dividend yield at around 13%, but we need to be careful here with the forecast dividend figures looking quite optimistic given the decline in earnings growth profile. And from our investors' perspective, the risk to reward ratio isn't justifiable for us to maintain an investment position in the stock right now. And moving on, another notable update this week came from Treasury Wines Estates, TWE's the code there. Management is forecasting financial year 24 earnings of between 418 million to 421 million. And that's slightly below the consensus forecast of around 423 million, Dan.
Yeah, that's correct, Kien. But interesting, the company actually provided forward guidance for the next 3 years, expecting earnings growth rates at around 12 to 15%. And these figures, of course, align with consensus expectations a little bit closer, hence the muted share price reaction on the day.
Yeah, thanks, Dan. And however, I noticed that they did allude to some pressure on margins in the short term, and that's due to the high cost of restarting their lucrative trade with China. And the company is also considering the merits of completely demerging their luxury wines business from their mid-price wine unit, with a decision due in August. So we'll be monitoring this development closely to understand whether a demerger would create additional value to shareholders. And now onto the topic that continues to captivate investors, the lithium market. Dan, you recently released a follow-up insights article. Can you give us a quick summary on what's happening in this space?
Sure, Ken. I guess it's hard to give a quick summary in lithium, but we'll do our best. So lithium prices, of course, they did make a bit of a mild recovery to start the calendar year, but we were cautioned investors at the time that we certainly weren't anticipating a snapback to any form of a recovery that was seen in the last few years. Rising rates and, of course, the moving of goalposts of emissions targets globally meant that electric vehicle sales, or EV, were somewhat slowing, but more importantly, supply of lithium out of Africa is growing at a staggering pace. And of course, supply continues to grow domestically within China as well.
Yeah, supply appears to be the main issue here, Dan, but we're not trying to predict where commodity prices are going here. But we do want to provide our members with the dynamics occurring in the marketplace. Remember, our thesis on these stocks are about the long-term compounding growth in lithium demand, which over time should see prices head higher. And these quality stocks in our universe, such as Pilbara Minerals, Mineral Resources, and Star stock Arcadium, will be beneficiaries.
Yes, that is correct, Ken. And of course, to provide a bit more further detail around our star stocks, Pilbara Minerals has very high quality operations, allowing it to generate those significantly high returns on invested capital, as you can see under Golden Rule 2. Mineral Resources is more diversified and is undergoing a significant investment program now, and therefore its return on invested capital is low, but will improve in the next few years. Meanwhile, Arcadium, which is currently not a star stock, but was formed from a recent merger between Allkem and Livent out of the US, has the advantage of having a vertically integrated model, which combines its chemical processing business with, of course, the mining operations that were out of former star stock Allkem.
Yeah, so lithium investors here will need to be patient as lithium prices over the long term start to recover. But in terms of the corporate calendar for the week ahead, Dan, Star Income Stocks GUD, they are expected to hold their AGM on Monday. In addition, you've got the REITs and also utilities, Arena REIT, Charter Hall Social Infrastructure, APA Group, BWP Trust, and Waypoint REIT. They are forecast to go ex-dividend towards the end of the month. And this week, under the microscope, we take a closer look at Arena REIT, our Star Income stock. We haven't done a property stock for a while, mainly because, they are considered quite dull investments. But for those who are new to the story, Arena REIT is really not dull at all. It's a real estate investment trust that owns early learning centres and also specialist healthcare facilities. So there's a bit of growth there as well. Daniel, what can we learn from their market update this week?
Yeah, well, Ken, management highlighted strong valuation support from Arena REIT's early learning portfolio, and that was really driven by continued improvements in childcare affordability. So participation rates in childcare and long day care are expected to increase in the medium to long term. Now, what does that mean for the business? Well, it's translating to a like-for-like rental reviews remaining very strong at around 4.9%. And of course, it has rental income increases linked to CPI until around FY28. And with a high CPI, that will support a growing operating cash flow and therefore dividends, Kien.
Yeah, definitely. Operating cash flow is so important for a REIT because of the rental income, which makes up the majority of that. But What's also interesting is Arena's healthy development pipeline, which includes around 16 early learning development projects with a forecast total cost of just over 100 million. For income, we prefer these REITs because they do have strong avenues for growth, which will ultimately lead to higher capital appreciation and dividends if done successfully.
Yeah, that's right, Kien. And of course, following the extension of its borrowing facility, we maintain the view that the company remains in a strong financial health position with adequate funds to distribute the 17.4 cent per share dividend in FY24, as you can see under Golden Rule 3. Arena stands out relative to other REITs due to the government-backed nature of childcare facilities. So it's strong inflation protection over the next few years, and of course, a robust pipeline of development opportunities like you've just mentioned. No doubt, these attractive dynamics mean that the dividend yield is only modest at around 4.5% for Arena relative to some of its peers, Ken.
Yeah, they definitely do have some quality assets there. But for those looking to compare other REITs within the sector, you can refer to our peer comparison table at the bottom of the 9 Golden Rules panel here. But with REITs, investors should not just be looking at the dividend yield alone. For example, across that list, you can see that Dexus, they appear to have the most attractive dividend yield at around 7.5%. But it is financially weak and is facing significant pressure with falling valuations across its office portfolio. So you've got to be mindful of this, and it looks more like a yield trap at this stage. And with many resources stocks under pressure from falling commodity prices, including lithium and oil, a useful question this week is how much exposure should you have to resource stocks in your portfolio?
It's a question I get asked quite frequently, Ken, by our members. But of course, deciding on this proportion requires an understanding of the active risks associated with holding such resource stocks and their impact on your total portfolio. Quantitative techniques are backward looking. So for resource stocks, you need to apply a qualitative overlay, as these stocks are very sensitive to commodity prices, as we've discussed. Therefore, you need to understand things such as the production profile, the quality of the assets, the mine life, and also the capital investment. Resource stocks can be considered not necessarily true growth stocks, Ken, as of course their earnings and return on invested capital move in line with the peaks and troughs of the commodity price cycle. As a result, their share prices are closely tied or correlated to the underlying commodity prices. For example, you can see that the price of Rio Tinto moves in line with the iron ore price on our advanced charting tool. Therefore, it is important to limit your exposure to resource stocks, as they can add earnings and share price volatility to your portfolio if you aren't monitoring them actively.
Yeah, be careful of concentration risks in this space. Currently, among our star growth and star borderline stocks, our exposure to resources is around about 27%. And this is high, even compared to the All Ords Index, which has approximately 23% exposure to the resources sector. However, remember, our star stocks represent a list of high quality stocks for long-term investments, and it helps you decide which stocks you want to choose. And we are benchmark agnostic, meaning that our sector allocation is driven by the strength of a company's fundamentals rather than by trying to minimize what we call tracking error, which is hugging the index like many other fund managers.
And on an individual basis, Ken, your exposure to resource stocks does depend on your risk tolerance and your return objectives. If you want less volatility in your portfolio, it makes sense to have less than roughly 10% exposure to resource stocks. However, if you see the recent commodity price weakness as a long-term opportunity, you can consider increasing your exposure. But of course, we suggest that you do not exceed an excessive limit, such as something around 30%.
Yeah, definitely. Or else you don't need resources as well, but just be mindful that sometimes resources can add significant value when you've caught it at the bottom of the cycle. But as an additional risk management strategy as well, remember, for trend sensitive investors, you may want to set up price alerts such as the SD30 TSR under the alert manager to remind you to remove a stock when the share price trend changes. You can also use the change alerts such as the EPS estimate change to help you remove a stock if price targets or earnings drop by, say, more than 10%. These alerts are useful for limiting your losses because earnings forecasts are tied to commodity price assumptions, which can change quite quickly.
And of course, Ken, you can visualize these factors under Golden Rule 3, outlook and active risks, and Golden Rule 4 using the SD30 TSR indicator or by selecting the EPS forecast 12-month trend indicator. And if you have questions, feel free to contact our team of analysts as always. Most likely you'll be speaking to myself on the phone.
Yeah, that's all we have time for today. And Dan, thanks again for your insights. Really appreciate around your insights around the resources sector and especially the lithium space.
No, good to be here for another week, Ken, and perhaps a bit of a longer episode. So I hope our members have enjoyed it. If you do have any further questions, of course, feel free to participate in our Lincoln Live webinar that we have on every Monday.
Yes, and with the end of financial year fast approaching as well, it may be a good time to introduce Stock Doctor to your family and friends so that they can take advantage of the upcoming promotion as well. So you can either do this by the Refer a Friend tab or send a link to the free trial page to them. Have a happy, healthy, and prosperous week ahead.